The failure of Silicon Valley Bank took just a few days, and the response from regulators has been almost as quick. So what did the regulators do? Is the banking system now safe? And then finally, should we buy the dip? If you do enjoy our content, please do subscribe to our channel. That way you won't miss any new videos. So let's look at whether the crisis is now over in a bit more detail. Let's begin with the joint statement by the Treasury, the Federal Reserve, and the Federal Deposit Insurance Company. Here are the respective mugshots of the heads of those institutions. Janet Yellen is Treasury Secretary, Jerome Powell's chair of the Fed, and Martin Gruenberg is head of the FDIC, which insures deposits up to $250K in the United States. And I think the two key parts of that announcement were firstly, that depositors will have access to all of their money starting on Monday, March the 13th, so no losses at all for depositors. And secondly, none of the losses associated with the resolution of SVB will be borne by the taxpayer. So this is very different from 2008, when depositors were also protected, but taxpayer money recapitalized the banks. And implicitly that also bailed out the shareholders and the unsecured bondholders, the investments who'd helped fund the company, the bank. Well, the legislation's changed since 2008, so that now what we get is not bailouts, but bail-ins. That's still good news for the depositors. They're still protected. They're at the top of the capital structure, which is very important. However, the people who pay for it will be the shareholders who'll lose everything, and the unsecured bondholders who'll lose probably almost everything. We'll have to see what happens in the bankruptcy proceedings, but probably the losses will be significant. Now, in order for these bailouts to be justifiable, these had to be systemically important banks, but they weren't systemically important before they went bankrupt. So what seems to have happened is that they've been retrospectively declared to be systemically important. Or as the Fed puts it, there's a systemic risk exception for Signature Bank, which is, I think, a little bit like awarding a Victoria Cross, a posthumous award for soldiers. You weren't considered systemically important before you went bankrupt, but hey, now you've got the award. The second statement was directly from the Federal Reserve, and they announced the Bank Term Funding Program, or BTFP, or should that be BTFD? So what's in the BTFP? Well, firstly, banks can borrow for up to 1 year from the Federal Reserve. Who's eligible for that? Well, it's not just banks, it's also savings associations, credit unions, anyone that takes a deposit effectively. What can they do? Well, if they do have high quality assets, such as US Treasuries, but also agency debt and mortgage-backed securities, they can use those as collateral handed over to the Federal Reserve, and they're valued at par. Now that is pretty remarkable. Let's imagine you've got a really long duration US Treasury. At maturity, of course, it'll be worth par, but right now it may be worth, say, 70 cents on the dollar. But no, if you give it to the Federal Reserve, they'll pretend it's worth 100. So that is pretty generous and quite remarkable. So what this loan program provides is an additional source of liquidity against high quality securities, which almost all banks have because they have zero risk weight. Banks have been really encouraged to buy US Treasuries because they used to be thought as being quite a safe instrument. But the critical point is that US Treasuries are safe if they can be held to maturity, which they now can given this program. So what the BTFP does is eliminate the need for fire sales of securities like Treasuries during these periods of stress. Now, if you want to keep up to date with events like SVB, but also learn about what's going on in the macroeconomic space and how it interacts with markets, then why not sign up for our free weekly market roundup? It's delivered to your inbox every Friday. We try to keep it short and punchy. And to learn more about that, just click on the link beside me and in the description beneath me. The UK subsidiary of SVB has been bought by HSBC. So it's good to see that the UK government and the UK regulators have been busy over the weekend as well. And the agreement was that they could buy the UK unit for 2 bob and a conker, as we say in the UK, or just £1. Now that's good news if you're a depositor of the bank or if the bank has made you a loan. So a lot of UK tech companies can breathe a sigh of relief. But I think it's fair to say that shareholders of the bank, HSBC, aren't necessarily happy about the deal. If you look at the share price of HSBC, the ticker's HSBA, you can see that it's fallen about 9% over the last 2 days. A big fall on Friday and then another fall on Monday after that announcement came out. But the important point about HSBC is that it is a globally systemically important bank. And that means that it has a fortress balance sheet with lots of regulatory capital to absorb losses, and it has to jump through the hoop of really strict stress tests in order to continue operating. So from the point of view of stability in the UK, I think this is a good outcome. Now the big question everyone's asking is whether this is going to stop the Fed from aggressively raising interest rates. And if you look at the Fed funds futures market, which is what the market thinks is going to happen to the federal funds rate, that does suggest that the Fed's going to step back from such aggressive rate hikes. Now, if you go back just 1 week, there was a hugely different outlook as to what the Fed was going to do this year. And the probabilities you can see here are for the Fed meeting in March, which is just a week away. So 1 month ago, the probability of a 50 basis point rate hike was actually 9%. Then a week ago, it rose a lot as Jerome Powell gave testimony to the US Congress, and he sounded quite hawkish. He suggested that they might have to raise rates by more than 25 basis points at the March meeting. And that was because inflation was still surprisingly high. And then at the end of last week, that probability was still 40% for a 50 basis point hike. But if we fast forward to right now, you can see the probability of a 50 basis point hike is just 0%. What's much more likely, according to the market right now, is either that the Fed does nothing, that now has a 30% probability, previously it was 0%, and there's a 70% probability that it'll raise rates by 25 basis points. So a huge difference in the market's expectation of what the Fed does. Much less aggressive rate hikes are now in the pipeline. What do investment bank strategists think? It's always interesting to hear that. According to Nick Timraus of the Wall Street Journal, Goldman Sachs thinks that there's not going to be a rate hike at all in March. And that's in light of recent stress in the banking system. And they say that after the March the 22nd meeting, there's considerable uncertainty about the path beyond that, driven, I suspect, by what happens to inflation, but also to the fallout after SVB's collapse. In contrast, strategists at JP Morgan say if they indeed have used the right tool to address financial contagion risks, time will tell, then they can also use the right tool to continue to address inflation risks, higher interest rates. So we continue to look for a 25 basis point hike at next week's meeting. And I think that's more likely to be right. If it does turn out that they've addressed the bank run risk, which is what everyone was worried about, then I think it's likely they'll return focus to inflation, which is still disturbingly high, and also the red-hot labour market in the United States. The point is that inflation is the biggest problem in the room right now, and that's because it affects everyone. Every citizen is negatively impacted by high inflation, so the Fed has to get that under control. So is the crisis over, and should we now buy the dip? Well, it looks like a lot of people think so. This is the sell-off over the past week, and then the rally over the course of Monday. So both the Nasdaq and the S&P are up quite a bit today. Now, despite the fact that we've got this incredibly generous BTFP program, which essentially ensures that deposits are safe for banks, there's still a big sell-off in regional bank stocks. Now, there's an ETF for those regional banks in the United States called KRE, which Eric Balchunas, Bloomberg's ETF guy, is referring to here. And he's showing how that was down 16% in early trading on Monday. And the volume was absolutely huge. There was $360 million of it traded in the first 10 minutes of trading. That's how much it normally trades in a day. And if we look at individual banks, again, you can see that some of these regional banks have fallen very precipitously. And that's despite the guarantee. In fact, trading was halted due to the size of those falls. Now, personally, I think that this guarantee means that these banks are now much safer. So if you're very brave and contrarian, then you would probably consider this to be quite an opportunity. So I've certainly been considering this one for my fund portfolio as a tactical trade. In conclusion then, I think what was most worrying about this crisis was that people looked at their deposits and thought they might not be safe. Well, I think this scheme, the BTFP and other schemes, has actually put those worries to rest. And that in turn means that the Fed can get back to the really important job of fighting inflation. People joke that the Fed hikes until something breaks, and now something's broken, maybe they're going to ease off. However, I think now that inflation's at not much less than 10% across much of the developed world, that's just unrealistic. Now that the systemic problem from SVB has gone away, I think inflation is really the biggest problem. So it's good that the Fed is back on the ball. From the point of view of banks, I think the consequence is that the cost of capital is going to be higher. In order to attract people to the bank, they're going to have to offer them a higher interest rate. And also, if bail-ins are now a possibility and a reality, then there's going to have to be a repricing of risk across the capital structure. People are going to demand a higher rate of interest on unsecured bonds, for example, issued by banks, if there's a risk of bail-in and a greater probability of loss, but also a greater loss given default if bail-ins happen. What does that mean for banks as a whole? Well, it's going to reduce their margins and ultimately their earnings growth and I think their prices. So it's not a good look for banks right now after these events. So I think it's far too early to definitively say that the SVB crisis is now over, but the very rapid and comprehensive response from US regulators has now made things like bank runs incredibly unlikely. So I think I might consider buying something like regional bank stocks in the US, or any shares which have been depressed, which I like the look of, might now be something to look at. So my market crash shopping list might get an airing soon. Now, don't forget our offer about our weekly market roundup. It's absolutely free. It comes to your inbox every Friday, and we try our best to make it interesting. To learn more about that, click on the link beside me and in the description beneath me. And, as always, thank you for listening.